Good morning.
All right, I like that. I like that laugh. Me Schneider from Market Gauge joining us here early on pre-market prep. Thinking about you and the modern family, but I'm first going to ask, how are you and how's your family?
Well, thank you so much for asking. I'm great. Santa Fe, finally spring. It's been very long in the coming. We had a really that we got into that whole Arctic winter here, which was unusual.
Whew,
So anyway, we're great. Everybody's great. I'm going to
that's
Vegas.
one place. It's one place Lisa says that's on her bucket list. Is she wants to go to. She wants to go to Santa Fe. We haven't ever been there. She said it's absolutely gorgeous.
Oh, well, if you do decide to come, please let me know for sure. We'll show you around.
Okay. All right. So here we are. We could go into the modern family here in a second, but me being in the markets, for many years, like myself, you get to points, right, where you get to turning points, and we've had this really nice rally, right? Not off the greatest information, or we whooped inflation, or there's a Fed pivot, but here we are. We're like right at the highs of the year. We're at earnings season, but we can't bust through. And obviously earnings are the most determinant of the market direction. But do you see like any other catalyst that could either, push us through that 4,200, make a new high for the year, or something to be more determinative, like, hey, you had your chance at the top of the trading range again and you missed it.
Well, what's so incredible is I've watched certain moving averages forever, and there's usually one or two that play out well. This year, more than ever before, there's this 23-month moving average that has been actually technically perfect, right? And the reason why I like this 23-month moving average this year is because you had 2 years of a business cycle, with 2021 being super bullish, 2022 being super bearish, and 2023 trying to figure it out. And there's a guy back in the 1800s named Benner who studied these short-term cycles within a big-term business cycle, which are typically anywhere from 6 to 10 years. So here we are trying to figure out where we're going in our next business cycle. And if there's anything that doesn't reflect better than this, I'm not sure what it is. But every time we get up to that 23-month moving average, we sell off. A couple of times, and that's been a while, that we've gotten near the bottom, where closer to where, let's say, an 80-month or a longer-term business cycle is, we hold. And that's the trading range of a stagflation environment that people cannot seem to wrap their heads around. So what would be the catalyst to get us through that 23-month moving average? Well, clearly we would have to see that companies are surviving the incredible speed of rate of change in the interest rates, that the Fed will stop, that pricing power has prevailed and the consumer can deal with not only higher interest rates, but higher costs of everything. And it seems like a tall order. We know the market looks forward. So if at any point it gets a glimpse that we can get through that, we may see the rally. But at this point, we may stay stuck probably even for another year, because this guy Benner goes 3 years, not just two.
That's interesting because I've talked about, the pandemic, a shock to the, not only to like to humans and society, but the supply chains. And you look at something, it was just going to take a long time to work itself out, right? Instead of perhaps going into a, restrictive mode with the Fed, they had to go the opposite way and just, monetary easing beyond easing. But I want to switch over to the modern family. Now, I forget, how many different members are there in the modern family?
Well, there used to be six, but we added a cryptocurrency through Bitcoin a few years ago.
So
So
now
now
there's seven.
seven, yes, the mighty seven, the fabulous seven.
Okay.
Um,
And there's always one, if you have seven kids, which I don't, there's always one that's kind of like misbehaving, right? At least one. And you hope that that doesn't spill into the others. And if I had to look at one that was misbehaving or giving me, I'd be like making sure he's doing his homework and staying after school. Um, this Russell, these small caps, man, I wish they would. I mean, they've rallied off the March low, but it's just like when they go down, they go down. When the market goes up, they don't seem to go up as much. What's going on with the little runt there, the small caps.
Gramps. Why? Actually, he's not the child. He's the granddad, which
Granddad.
is
Oh,
which is even more disturbing because he's certainly showing his age right now, and we know that there are times when he's seemingly taken some good medicine and vitamins and gotten going, but exactly right. So the small caps, what do they reflect? They reflect 2,000 stocks that are all really basically manufactured within the United States. So if you want to see economic stress, that's where you go. Now, the stress is not as bad as it was, say, in October or even when we sold off again in December, and it has been holding. But if you look at its performance relative, say, to the NASDAQ or even the diamonds, it's been really horrible. And so until we see those small caps, they can't even get through 180 if you're looking at IWM, let alone that 23-month moving average that I was talking about, which is over 200. So even if we got through 180, we'd still not be out of the woods and showing any level of expansion. And why I'm mentioning that moving average is over that area is a sign of expansion. We are in stagnation when it comes to especially the small caps. And of course, I heard before I came on, I heard you all talking about KRE. That's our prodigal son. So he's also not behaving very well. And he actually gave us the very first sign right before the banking news came out in early March. That KRE instrument already broke down. And forget the 23-month. That thing is below everything, below the 80-month. It's really showing that's where you're really seeing the deepest signs of recession. If it can't play catch up, it will continue to be a thorn, I believe, for everything.
Definitely. We don't want to see that because we've seen enough uncertainty definitely in the regional banks, but it seems like at least the bigger banks have been doing well, right? And one thing that I have seen for sure is a little bit more sign of confidence. Are you concerned about any financial worries out there, or are you feeling a little bit more confident about the situation?
Well, I feel the same that I've really basically felt all year, which is when you have a trading range like we have, and it's very similar to former history trading ranges when you're in this type of situation where there's been accommodative Fed policy, the dollar's not sure what it wants to do, inflation is creeping up still, even though people don't want to really talk about it. And you have a point where there's a lot of cash on the sidelines, so investors are still wanting to jump in. To me, this is really exactly what I would expect, which is I would have more confidence if we held great support levels than trying to buy a rally against a trading range unless I saw some real shift in the macro. And that would have to look like, first of all, inflation. So we haven't really talked about that nasty word, but I'm sure you've heard rice. The production of rice in India down 31%, and Pakistan, because Pakistan had huge floods. People seem to think these Mother Nature cataclysmic events don't have any impact on food. Sugar's been in shortage. I even read olive oil is 20% higher than what it was. And we know even though the grains have come off, that can change at any point. Certainly here we've had some issues in terms of our growing season. So I'd like to see that cycle has to go through. And what I try to explain to people is you can't point a finger, this is this fault, this is that fault, this is this fault. This is years of low production in terms of food crops because prices were cheap and there was abundance and demand and supply were being met. COVID happened. I don't have to go through that whole history, supply chain. I heard you guys mention all of that, labor. But now we're in a situation where things got planted, but Mother Nature didn't behave. And it takes a while to see these things cycle back. It could be another 2 years before we start to see abundance of crops in these things. And so that's why I'm really sticking to, I'll be confident that you can catch some short-term pops, and certainly we have, particularly in tech. But in terms of my long-term bullish picture, I think we need to be a little bit more patient, and we may be looking out to 2024, 2025 before we start to see all of this stuff sort out, and the market could then carry on to where it used to be before COVID.
All right, let's go to another big part of the economy that touches on business. It touches on the consumer, leisure, travel. transportation. I mean, I'm looking at old grandpa. What it's what about the transportation index just hanging out not looking great. What's your take on that?
Well, that certainly a great question, Joel. That would be probably KRE would have to hang in the game, but it wouldn't necessarily have to start leading. That we could really wait a long time for that to happen. But transportation, I have seen in the past when people get really bearish in the market and all of a sudden transportation pokes its head out and starts to lead, and then the rest of the market catches on. And why? Obviously, demand. So if we start to see good demand, no matter what you're hearing in terms of the numbers, it's telling you that if demand is coming back, things aren't as bad as we think. So right now, transportation is actually doing better than even than KRE, but even XRT, which is retail, that's grandma, that's not doing so great. But transportation actually poked its head up and now is bumping into the resistance around this 228, 229. I'm looking at IYT. And if that could get going past these levels and get through, say, 240, that's the key 23-month moving average. That would tell you that we're starting to see expansion and not just a pop off the lows. In the demand sector, that would probably be the catalyst to get me feeling a little bit happier about the turn of events here for this year.
All right, so now we can go, of course, to the health of the consumer, right, with XRT. And this is a very interesting area for me because I think this is going to be kind of the real kind of binary situation, right? Recession or not recession. What do you think here, Mish?
Well, right now, Granny's not looking too happy either. So that is a concern. So as much as demand could hold up here, we know if it can't continue and it looks around the family. And this is kind of why the family works so well, right? Because one of them starts leading, looks around, waits for some company. And if that company doesn't transpire, then we know that family member starts to turn down. And that's kind of where Granny, which is obviously the consumer, and then demand, they work in sync very, very often. So if XRT, and we haven't even begun really earnings in the retail area, if that cannot hold up above 59.60 in XRT, that would now be much more concerning, not just for recession, but also even that we have this expanded stagflation scenario, because if we can't bring those costs of goods down, and this is why you're seeing silver up and gold up and sugar and coffee, these softs. If the consumer can't hang in there in the cost of that and this breaks down, then I think we would probably start to be looking at SPY closer to 3,500, maybe even lower. I mean, so we're at a really critical junction right here, but I wouldn't get too bearish or too bullish while we're stuck in the middle of this range.
All right, the tech trade has been strong. The mega cap tech has really brought us off to the levels that we're at. And also the semiconductors. What a move you've had in NVIDIA, AMD, LRCX is moving higher this morning. So if you want to point to a positive here, I'm looking at the Van Eck Vectors semiconductor ETF. Man, just got a big bid. Well, it's losing that bid at 250 today, but nice move in that. And that touches AI, and it touches cars, and it touches so many different parts of our economy. Is this something that's a little bit of an optimistic sign to you, Mish?
Well, she's also in our family. Like I've tagged them into characters. This is Sister Semiconductors, often whom we call Wonder Woman, right? Because tech has often led many of the rallies that we've seen over the many years, and we know they can't be sustained again without the rest of the family following. Now, semiconductors is the only one of the modern family that has actually broken her head above this 2-year business cycle, trying to show some level of expansion. But just like everything we just said, if there's no follow through with the other sectors, we know what happens. That area looks around and says, what's wrong? Whether it's rising interest rates, rising costs, whether it's geopolitical stress, obviously there's that buzzing around, then you know that can't sustain. So with SMH right now, It's certainly been the place to go make money. I hope people take profits on some of these moves. We've been long, let's say, NVIDIA, for example. But if it breaks down under 246, which is exactly where that 23-month moving average is, as we end April, because it's a monthly moving average, because the rest of the family says not so much, then I would say that that tech could actually reverse hard because it's been the most crowded space for the bulls.
Kind of been holding us up here, that's for sure. Mish Snyder from Market Gauge, a long-term guest and fan of the show, joining us here on Pre-Market Prep, giving us a very, very broad outlook on the markets, which we always appreciate. We already appreciate it. Cautious, but trying to remain optimistic. Thanks a lot, Mish.
Thanks, Joel. Come to Santa Fe.
I am. We're on the way.